The problem with centralized money. Your money sits in a bank. It feels safe. But have you ever asked who actually controls it? Not just your account, but the entire system behind it. The answer explains why Bitcoin was created in the first place. All the money we use today is centralized. That means a small number of institutions manage the system behind everyday payments, savings, and transfers. At the top are central banks and governments. They manage the money supply, influence interest rates, and oversee the financial system. Under them are commercial banks. These are the banks most people use every day. They sit between you and almost every transaction you make. So if you transfer money, use Pay Now, swipe your card, or receive your salary, banks help process it all. A simple way to picture this is like a pyramid. At the top, the central bank. In the middle, commercial banks. At the bottom, everyone else. In this system, major financial decisions are made by central authorities, not by individual users. Now, this system does offer convenience, but there are trade-offs. The first trade-off is inflation. Over time, governments and central banks can increase the money supply. When more money exists, the purchasing power of savings can fall. You've probably seen this in real life. Years ago, a kopi might cost 80 cents. Today, it can easily cost more than $1. Your bank balance may stay the same, but what that money can buy changes over time. The second trade-off is control. Because banks manage accounts and transactions, they can restrict certain activity. Transfers can be delaying, accounts can be frozen, and payments can be blocked depending on rules or policies. The third trade-off is access. Sending money across borders often takes time and fees because the transfer may move through several banks before reaching the final destination. So even in a digital world, international payments can still feel surprisingly slow. And these issues are not just theoretical. In 2008, the global financial crisis shook trust in banks around the world. In 2013, Cyprus restricted bank access during its financial crisis. Then, in 2019, Lebanon limited withdrawals during its banking crisis, and many ordinary people could not fully access their own savings. These events showed something important. When money is centrally managed, policy decisions can directly affect how people access their funds. Quick question. When was Bitcoin created and what major world event happened just before it? Think about it for a moment. Here's the answer. Bitcoin launched in 2009, right after the 2008 global financial crisis. It introduced a completely different idea for money. Instead of a system controlled by a central authority, Bitcoin runs on a decentralized network of computers around the world. Instead of an unlimited supply, Bitcoin has a fixed limit of 21 million. No one can decide to create more whenever they want. And instead of relying entirely on banks, users can directly control their own funds. Bitcoin was designed as a response to the limitations of centralized money. But it's important to keep a balanced view. Centralized systems provide convenience, regulation, fraud protection, and customer support. For many people, those benefits matter a lot. Decentralized money offers more independence and control, but it also comes with risks. Bitcoin prices can rise and fall quickly, and if you control your own funds, you are also responsible for keeping them secure. That means there is no bank hotline to call if you lose access. Understanding both systems clearly is what makes someone financially literate. So, to recap, today's money system is largely controlled by banks and governments. Inflation can slowly reduce purchasing power over time. Access to money can sometimes be restricted during crises, and Bitcoin was created in response to these limitations. Follow us for weekly crypto education made simple. This content is for educational purposes only and should not be considered financial or investment advice.